A very good afternoon, friends. It gives me immense pleasure welcoming you all for today's webinar on IPO, how to prepare for IPO on main board SME. Thank you for all for joining our journey and encouraging us. Friends, an IPO is a process by which a company offers shares to its stock to the public for the first time. The decision to go public and the choice between listing on the main board or SME board is a strategic decision that require careful consideration. First point is that you want to go for IPO. That is a very strategic and very big decision. The main board is a primary market for trading of securities for larger and more established companies with a strong track record track record of financial performance and a larger market capitalization. Listing on a main board can provide greater visibility and liquidity, as well as access to a wider pool of investors. The SME board is a specialized market segment that cater to smaller and growing companies. These companies typically have lower market capitalization and less established track record. Listing on SME board can provide companies with greater flexibility and lower cost of compliance, as well as access to the investor who specialize in a small cap companies, and their size of lot is also bigger. When deciding between the two, companies should consider factors such as their size, financial performance, growth potential, industry, regulatory requirements. Companies should also carefully evaluate the cost, benefit, and risk associated with each options before making this decision. Friends, today the key issues for discussion which we want to discuss. One is eligibility criteria for IPO on main board and SME board. Then pre-IPO preparation, that is very important. IPO readiness assessment. And key step involved in IPO readiness is assessment. Now, this is one very important aspect which we will discuss this, because if you are planning to bring out IPO, then IPO readiness is more essential, because IPO process is 1 year. If you are not ready, then it may take 2 years also. It is not that today you are deciding and you can start. So we will discuss that what are the steps, what are the points that we will discuss. Then financial analysis during IPO, because when you do IPO, then you have to see what are the financial analysis, your valuation, your other parameter will be discussed. Corporate structuring, when you are bringing out IPO, then your corporate structure should be very clear. That is also important. Governance aspect, which is the most important today when you are bringing IPO, because you are going to the public, and the public wants to see everything which should be in a rightly placed. Then detailed due diligence is also required, and this due diligence is directly connected with governance and other aspects of compliances. Then brief overview of IPO process on main board and SME board, and post IPO engagement, because sometimes what is happening, IPO journey is not over when you are bringing IPO. The remaining part is start next, because you have to have so many things which you have to do. So today we will discuss. So we have eminent speaker for today's webinar, Mr. Manoj Kumar, partner head, M&A and transaction, corporate profession. He will discuss all the preparationness. Then Ruchika Sharma, she is associate partner in corporate profession. Then we have Ankit Singhi, partner and head corporate law, who will discuss about the governance issue and the due diligence part. So before starting today's webinar, I just want to show you some parameters, that what is the IPO trend going on, and how the India and how we are ready to take this IPO route to a new success. Now, every company is planning to bring out IPO. So first we should understand that what is a trend, and then I will discuss some important aspects. So IPO trend, if you see today, that year 2021, we have seen the record growth across the global market. 2022, it was a dip, but the dip was not that because COVID impact was there. But now you see that this trend is going up. So 17, 18 was good, 18, 19 was bad because of certain reason, then 19, 20, and then 2021. These are the 2 years of the COVID, and then suddenly you have seen there is a spurt, and now the future is uh, bright for this IPO market. Next. Now, if you see the IPO trend, show next. So what is the trend going on? The IPO trend, if you see the industry-wise, then in 2018, construction industry, trading and distribution, aerospace, defense, gems and jewelry, and consulting service, this was the trend. In 19, we have seen construction industry was again, trading and distribution was again taking place. Hotel and resort has come, gems and jewelry was also, and watches and consulting companies. Only hotel and resort has taken place in place of aerospace. Again, into 20, computer and software industry issues came, that industrial product, pharmaceutical, building project, specialty chemical. So total change of trend related to industry. Next is in 2021 and 22, this is also construction again has taken place, auto and component, aerospace, capital goods and consulting thing. It is just auto component has again taken place. There's a new segment which has come in a big way. 22, if you see, capital goods is topic, then industrial product, FMCG, gems and jewelry, and construction. So friends, construction, gems and jewelry and watches appears in 3 out of 5 years. So construction is expected to continue grow because government is also investing heavily in the infrastructure, and they have a plan to invest 145 trillion by 2027. And when they are spending, then other industries relating to this construction, they will also grow and they will require fund and they will come in the market. Additionally, we have seen urbanization is taking place. So housing and commercial building is also taking place. Indian stock market has been performing well in recent years with the benchmark indices reaching new heights. This is making attractive for the companies to go public and tap the abundant liquidity and investor appetite. Then if you see the IPO trend relating to oversubscription. Now, why I'm saying in 2013, Just Dial, it was 12 times oversubscribed. Sharda, 2014, 60 times. BRL Logistic next year, 74 times. Quest Corp, 144. Salasar Techno, 273 times. Apollo Micro, 249. Ujjivan Small Finance, 166. Mrs. Bector Food Specialty, 198%. And Latent View and Analytic, that is 326%, which is the highest. And Harsha Engineering International, 75%. And 23, this is the starting 17 times the Shah Polymers. Now, this oversubscription shows that how much hungry is Indian market, Indian investor, and for IPO. So somebody is asking 1 rupee and you are giving 326 rupees. That is one point which we can understand. The market is, the appetite is good and people are ready to invest. Now, another point is that what is the prospects of Indian IPO? So the prospect is very simple. There is a need, the people are bringing money, they want to invest, they are coming out big way. And over past decade, we have seen Indian companies witness tremendous growth in private equity investment. And in 3 years, 392 P deals were signed across India, amounting to rupees INR 5,000 billion. On an average, Indian equity firm invests for 3 years in a firm and eventually look at exit by IPO. So P fund, they invest, they want to grow, and then they want that these companies should give an exit. Exit is a most probably going by IPO route. So you can understand that market is big and so many people, they want to, uh, um, so many industry, they are coming in the market. Now, if you just see, these are some prospects and why I'm saying Indian market is very bullish. The reason is very simple, that today what is happening, we have a 26.7% saving rate, which is highest in the world. Now, the saving rate means that Indians are saving this percentage. So every household, they are having a saving. Now, these savings, where they are investing majority in gold and property. Now, these are, or they are putting cash in their own locker. Now, these are the three things which are, no doubt, it's an investment, but this is not a productive investment. If this money is coming, so people are investing either in FD, when they are talking about the banking sector, either in FD or some other way. The equity investment in India is not much because there are so many reasons. No doubt, these are the changes taking place. We have seen, we were having a 4 crore depository accounts. Now, after the COVID, it is 10 crore. So you can understand that out of 140 crore our population, we have only 10 crore depository accounts. It means the penetration is very less in the entire capital market segment. So the growth opportunities are much. Only thing is, the investors are ready to invest money, but they want to invest money in a good companies. They want to invest only when they think that their money is safe. So that's why what is happening, that our government is also realizing this point, that without capital market development, without public equity participation, the loan economy cannot give boost to the country. Government wants to make 5 trillion economy. Now, 5 trillion economy can take place only when the private participation is more. And this 26.7% saving rate, if it is channelized in the equity market, the market and the country can achieve faster the 5 trillion target. Now, it is an indicator. Now, what is indicator? I have told you the 10 crore market, 10 crore depository account. And if you see, this is a recent trend, that previously the capital market or trading was taking place only by the people were saying FIs are selling, FIs are buying. If FIs are buying, the market will go up. FIs are selling, market will go down. But the trend is changing. Now, retail investors are coming in the trading, and that amount is coming to 52%. And the FI's investment is now around less than 20%. And the Indian domestic market is remaining. So you can understand the FI's influence and FI's dependence on our trading is reducing drastically. So this is a good sign. And this is a good sign for all industry, that they should realize that this is the right time. Public is ready to invest money and they can bring out their IPO. But IPO bringing issue is, there is a one important point. The point is, the investor has burnt their fingers so many times because so many people are coming which are bringing out issue, manipulate by various things and bringing money, and then they are saying. I was just having that these are the oversubscriptions companies, which as I have shown this Just Dial and Shraddha. Now, majority companies' share price is down as compared to their issue price. Okay, only few companies which are oversubscribed, that is going up. Their price is higher than the issue price. So sometimes the valuation issue is higher. The investors are puzzled about this, that they have invested money and they will not lose money. Sometimes the various aspects. That's why today if you are bringing out IPO, SEBI is very tough. SEBI is asking complete postmortem of the organization. So friends, today's program, which we have designed in such a manner that all economic aspects of Indian economy is growing up. We have seen that share economy is going up. India is bringing out this COVID has brought out something positive in India. Then India has put in a target of 5 trillion economy. Our GDP is highest in the world. We have a 140 crore population. We have a highest number of middle class, which has a good investment of capacity. Market size is going up. Indian export is going up. Private equity and FDIs is going up. Foreign reserve is also touching the highest as compared to the past year. Digital economy is going up. The trinity of GEM is also giving boost to Indian economy. Our GST is continuously growing, 1.5 lakh crore rupees, that 1,50,000 crore rupees that is going on. Make in India concept is going on. We have seen semiconductor, which was a need of industry. Because of that, so many automobiles, other industries were facing problem because China was the only source. So India is bringing out. The PLI scheme is giving. Liberal FDI is also giving boost to the Indian economy. Indian startup system is going up. 75,000 startup in India. They are the highest number of unicorn. 110 unicorns are coming, and they will bring out IPO after some time. We have seen that new economy is also coming. New economy. So what is a new economy? New economy is which is disrupting traditional industry by creating new opportunity for consumer and business and driving business. So technology innovation by potential technological innovation is bringing out new economy industries, e-commerce, fintech, AI, renewable energy, sharing economy like Ola, Uber, Airbnb, virtual augmenting. Now, these are certain industries which are coming in India, other than the traditional industries in India, which is required. Because India, everywhere you go, everywhere construction is taking place. You require metro in all the cities. You require airport. You require. So when I'm saying airport, then there are so many connected industries that is coming in India that is in private sector. And all these companies require fund. And for that, you require IPO. So this is the Indian growth story. And that's why every company should gear up today to bring IPO. Now, some rider, which we have to understand that if you are bringing IPO, so bringing IPO is a process. And this process is that you have a good company, good business, but you may not be ready for IPO. Because IPO is just like that at the time of wedding, when we see the bride, which is going to parlor, putting best dress, putting everything best. Same thing is IPO, that company should go to IPO and it should have everything complete. Nothing can be, you can say that you can take some standard thing. Now, what is this required for IPO in a company? First is that you should understand that your corporate structure should be clear, because investors are not investing money when you have a confusing corporate structure. People have started companies and they have various subsidiary companies, various companies where they are doing business here and there. That investor, they are not interested because they want everything should be clear, ownership should be clear, the brand should be in a clear cut in the company. So that is require a corporate structuring that Manoj will discuss. Then second is financial restructuring, because you have a financial your capital structure should be good. It should not be in such a manner that it is giving a wrong analysis and wrong impression. Sometimes what is happening, you have your related party transaction, you are doing for good, but investors are not understanding and they are not liking this, that you are giving loan, even you are giving loan without any interest. They want that everything should be clear and on a professional basis. Then the governance process should be there, your board process, your everything should be in a complete clear manner. Next is valuation. When you are bringing out your company, your valuation should be uh, best for you. But how to make the valuation? So you have so many asset in the company that is tangible and intangible. Now all tangible, intangible things you have to bring out. Today, what is happening? You have a market distribution channel, and your distribution channel is a intangible. So now this distribution channel has a value. So you have to bring out. So everybody who is bringing out business or starting a business, making this type of channel is a time consuming and it requires lots of efforts. So you have this type of thing. So you have to bring out that what is unique you have, what are the best thing you have, what is the differentiator you have. If your cost of production is less as compared to others, it is a value, it's a intangible valuation which you will get. So these are the things which you have to do this. And then you have to make a future story also. What is your future plan? How I should, how, because investor will ask that I want to invest in the company. What is your growth plan? What is the future? Why I should not invest in an established company? Why I should invest in your company? If you are giving valuation low, so investor can understand that comparative valuation is better, so I can invest. All these things you require. Then what, how much fund you require, what is the best ratio of equity and debt, it should be there. So these are the things which you have to work out before bringing out IPO. And the most important thing which I find that when we are discussing various companies for IPO, they are missing infrastructure. And that Ruchika will explain to you. Infrastructure means that you are ready for bringing out IPO. The first infrastructure is your mindset, your basic understanding of, of a unlisted company and listed company. When you are listed, then you should understand from day one, you have to have your accounts ready. Your account should be, quarterly result should be ready. Everybody can ask you information. You have to give information to regulator, you have to give information to the shareholder, you have to give information to various people. Today, if you are an unlisted company, you have to prepare annual accounts, but here you have to prepare the quarterly accounts. So whether your infrastructure is ready to do this, whether you have a competent team of professional, whether the whatever happening in the company, you have to give information to the stock exchange. So the for the public, are you ready for this type of compliance? That require your team of legal, team of secretarial, team of financial should be in place. And that is the biggest problem which I am finding. Various companies has good business, good system, but they are missing this. And then your system is also perfect. You should have ERP software, your system should be there, you have multiple offices, you have to collect all information. All these things, in if they are in place, then you can think for bring out IPO. Now, this is the basic aspects I have told you. Now, how to do it, the nitty gritty, and how to start this, the Manoj will explain to you, because IPO is a process and each and everything should be meticulously planned, meticulously understand. So this is not one direction that you are talking to somebody and they will bring out. Role of merchant banker is there. role of investment banker is there. But the question is, are you ready? So merchant banker and investment banker, they will bring fund and they will go away. But ultimately, you have to perform and you have to give to the market the desired result which you have promised. That require lots of preparation in advance. So how to do this? What are your things? How to do the valuation? The Manoj will explain to you. Over to you, Manoj.
Thank you, sir. Good afternoon, friends. So it is one of the very important topic we are discussing today. That is the IPO and preparation and roadmap to go for IPO. We all understand that IPO is one of the most important milestone in the life of a corporate. So obviously, it requires a lot of preparations. As Pawan sir was telling, a company need to be thoroughly ready. Then only think of an IPO. So I will run through my presentation now, and we will discuss various aspects of the same. First, we need to understand what is the life cycle of the corporate and what are the options available for fundraising. Here we are talking about fundraising aspects relating to equity and equity related instruments and not the debt, because debt is obviously a traditional way of raising funds, which happens in most of the companies which are traditionally brick and mortar companies, and they need funding to start a project and they get the funds. There are leverage ratios accordingly. Funds can be taken from the market, banks and financial institutions. So that part is we are not discussing here. We are discussing the equity fundraising options available and at various stages of the life. So first stage and initial stage, if we are talking about life cycle of a company, is the initiation of the idea, and concept. Just after the idea, initial funding is required, which is called the seed funding, which generally put in by the founders of the company or promoters of the company or their family members. So that is the starting point. From there, they may get some friends and corporate houses, family offices, which can give additional funds in the form of angel funding. So that is the second or just after the initial funding stage. After that, if the company starts growing and it has started showing the real data, real financial numbers, then they may think of a venture capital funding, which is obviously the second stage funding, and it is the high growth period of phase of the company. So in that phase, venture capital funding is very important, and they help in the company to grow and become mature. As the company gets mature, they may need further funding for additional growth and faster growth. For at that moment, the private equity funds come. And when the private equity funds come, the venture capital fund and private equity funds are funds created whether in India or outside India. They have limited partners who have put the money. And generally, the funding cycle is, we may say, 3 to 5 years. After that, they need to exit from the company. So that is the stage. And they believe, the private equity funds believe that if we start to put the money, within 3 to 5 years, the company becomes a mature company and it becomes a sustainable growth level. So that is the maturity stage where IPO comes into picture. So IPO, as Pawan sir was telling, it is the first time when the company hits the capital market and raise the fund from mass public shareholders. So this is the standard timeline. Now, recently we have seen a change in the trend. Government has allowed around in 2012 the SME IPO, which is for small and medium-sized enterprises to go for IPO. This SME IPO is a new trend, and now we have seen in the last couple of years that this market has also helped the companies to raise fund. So here, company may skip the venture capital fund stage or private equity fund stage and directly go for SME IPO to raise fund from the public. So this is a new trend, and it is also giving a very good return, very good help to corporates in growing through this new mode. What are the major types of IPO? So there are the three major type of IPO. One is fresh issue IPO, where new capital is raised and the company issue new shares to the investor as part of the IPO. In this case, the funds come into the company for its growth. Then another part is offer for sale. So if the company has sufficient fund for its own growth and business operations, but there may be some investors which want exit from the company. So here comes the option of offer for sale. Here, existing shares, equity shares are issued to the public at large, and the fund raised is given directly to the shareholders of the company, which may be venture capital fund, private equity fund, or part of the promoter, or one partner of the company which now want to exit from the company. And the final part is the combination of the fresh equity and offer for sale. So some part of money comes into the company and rest of the fund goes to the shareholders of the company. What are the benefits? Why a company should think of going into IPO? Pawan sir has discussed that there are a lot of preparations required. There are a lot of strategic. This is a strategic decision which requires graduation, which requires a company to become more vigilant, better governed. Regular financial disclosures are required. There are accountability towards the public at large. But in considering all these hassles, why a company should think of going to the public? So first important aspect is unlocking of the value. As the company gets listed, its market price is reflected every day. So it becomes the worth of the company is clearly visible to everyone, and that makes the company's a hidden value in public domain. Then further capital raising, fundraising has become very easier if a company listed company. And there are access to the institutional investors which invest only in listed entities, listed companies. So they start investing into the company, and it becomes the fund comes easily into the company. Then as soon as the company gets listed, it is quoted every day. Leading business newspapers, magazines, websites also start tracking to the same. So it gives a lot of visibility, brand credibility, and recognition. Even bankers start thinking that they are more reliable because the financial numbers are available every quarter. So that gives a lot of strength to the company. It helps in enhancing the credit rating of the company, because obviously financials are not old. It is real time available in the market. So it gives confidence to the rating agencies, and they give better rating. So if we get better rating, we will certainly get a lower rate of interest from the fundraising in the debt market. Then it gives liquidity. The promoters and the stakeholders can easily sell some part of the share or all shares and exit from the company, raise money from the capital market. So that is one also very important aspect. If we talk about the investors of the company or shareholders and promoters, so as soon as company is listed, their net worth, their value is clearly visible in the market. So that helps them to unlock their value. Then obviously a person who is a promoter of a listed company can clearly say that I am worth, let's say, 4,000 crores company. I am the owner of 4,000 crore company. So it gives brand equity, increases the brand equity of the promoters. Sometimes promoters or one of the promoter group persons may require funds, so they may liquidate part of their stake and raise the fund easily. It will also help in doing multiple kind of transactions, like pledging certain shares and raising fund for other ventures whenever there is a requirement. And exit opportunity also is available if they want to exit from the company. There are better buyers available in the market for listed entities than any closely held private company, because of the various reasons which we have already discussed, like brand equity enhancement, disclosure, better disclosure, financial discipline, etc., etc. So these are the benefits. That's why a company must think of going to a capital market if they are a mature level company and growing, giving good return to shareholders and investors. We can now discuss a few recent case studies of IPO, successful as well as some failures. So here are some of the cases, like Adani Wilmar. If we talk about this company, though recently there has been a dip in the market of all the Adani Group companies, but if we see from the IPO point of view, when the IPO came, its pre-money value was around 26,000 crores. Post-money, just after IPO, it was around 29,000, 30,000 crores. And on the date of listing, it listed for 34,000 crore. And presently the value is 53,000 crores. So almost more than double is the value within a short lifespan. So by this, you can see the investors who have subscribed in the shares of the company at the time of IPO would have got very good return from the company. Another example is the Vedant Fashion, which is the owner of the brands like Manevar and Mohi. So pre-money valuation was 21,000 crore, and they have obviously came out with the offer for sale. So there is no difference in the pre-money and post-money valuation. The post on the date of listing, around a bit a small gain was there. So around 22,600 crore was the market cap just after the listing. And now at present it is running around 28,000 crore market cap. Then we talk about a smaller size company like Hariom Pipes. So pre-money value was only 260 crores. It raised around 130 crores. So post-money value was 390 crore. On the date of listing, it became 572 crores. And right now, if you see, it is around 1,160 crores market cap company. So we can see substantial gain, around almost 4 times increase in the market cap and valuation of the company. Then we talk about the Campus Shoes. So at the time of pre-money value was around 8,800 crores, and post-money, obviously it was also offered for sale. So there was no difference, but just after listing, it became 11,500 crores. Presently, it is running around 11,900 crores. So again, there is substantial gain in the value of the company after listing. There are other cases where the valuation could not sustain, like Delivery, Zomato, PV Fintech, Inox Green, 197, Nika, etc., etc. So many of them are startups where the valuation fundamentals were not so robust. They were the startups which started and they have got good valuation in the private equity rounds, different rounds of private equity, and private equity were willing to exit, and hence IPO came. And IPO was obviously, in most of the cases, these IPO were successful, but investors could not get benefit, and slowly, as soon as the anchor investors exited, the price got crashed, and so most of them have lost substantial market capitalization post listing. So it is very, now from these examples, it is very clear that right pricing, right timing, and right valuation is very, very critical for any IPO. So preparation of the company is one side, and successful IPO and post IPO success is also important, so that the company can continuously get funds from the capital market. If the investor loses money, they will not further invest into the company. So it becomes very critical. What are the 3 major aspects of success of an IPO? As per my understanding, these are the 3 very important aspects. One is robust financial systems and finances of the company and the performance of the company. Then realistic valuation and right timing. If we do all these parameters, we are fitting in all these parameters, any IPO can be sustainable. So if we are talking about the robust financials, obviously, because after IPO, company need to give financials every quarter, and market expects that they keep performing every quarter and show growth in various aspects like top line, bottom line, net worth, EPS. All those parameters is tested every quarter, and based on that, price earning multiple is disclosed and various investor analysts give their reports about the company. So it is very important that company is ready, and IPO is brought at the stage where the financial performance is consistent and regularly growing. It is not only about the financial, sometimes non-financial performance is also very important. So brand is increasing, you are doing inorganic growth steps which are disclosed to the market properly, and that their result may come at a later date. Still, you can get a good valuation, and good IPO can be successful. Then valuation should be realistic. If the promoters are company management wants whatever is the fair value of a company as compared to listed peers, they would like to get all the money at the time of IPO. Then there is very likely that just after the listing of the company, the value may not sustain or may remain stagnant. which will not give good return to investors. And then obviously they would like to exit from the company. So there will be sale and there will be price crash. So these are the, so right, realistic valuation is very important. Here we have to understand whenever a company is getting fund from private equity or venture capital fund, they enter into an agreement with the company and management, shareholders, existing promoters, shareholders, and there they have various protective rights. So they obviously can take more risk. Otherwise also, equity is always a risk capital, so risk is always higher. Still, they have protective rights. However, in case of IPO, the investors are wide and spread, vastly spread, and they don't have any special right as compared to the management who are looking into the performance of the company or making decisions. So obviously, they would like to, if the risk is higher, obviously return expectation is also higher. So there need to be a gap between the fair valuation which we can get in private equity or venture capital deal versus an IPO. IPO, there should be some value should be left for the public, so that when they subscribe, they get good gain in the after listing. There can be two kind of investors. One, some of them would be who are willing to exit from the company just after the listing, so they want listing gains. But there are another class of shareholder who want to continue with the company, and they would like to grow their wealth with the company. So in both the cases, there should be some discount from the fair value, so that their expectations is met, so that they will invest further whenever the company comes out with the right issue or follow-on offer, or whatever way they want to raise the fund. These performance would be tested. Then the right timing is also very important, because capital market is very volatile. Sometimes it seems good for one industry, sometimes it is not good for another one industry. Then there may be external aspects, internal aspects. So timing is very, very important. If the timing is not right, then even best of the company may not get good response from the capital market. Now we come to the most important aspect, which is how to prepare for an IPO. So there are various stages. Pawan sir has told that the preparation of IPO generally takes 1 year, but sometimes it may be even longer. So what is the stages? The first stage is strategic consideration and IPO planning. So first decision making should be there, that the company would like to go for IPO, and that decision is based on various factors, like whether there is no other option of raising fund like private equity or maybe debt funding, and equity dilution at this point is the right strategy. So that decision is to be taken. And then various other related aspects, like what will be the growth plan, if the money is coming into the company, how it will be deployed, what will be the benefits in the size of the company, growth of the company. Those aspects need to be considered while planning for IPO. Then as soon as the management in principle agree that they want to come out with the IPO, they must start a process of corporate health check and readiness process. So corporate health check, I will just elaborate in the next slide. Here we have to go deep into the various aspects of the company and see whether this is the right time, the infrastructure ready, governance aspect is ready, and company can go for IPO. And then real IPO process starts, and then obviously post IPO aspect is very important. That it includes robustness of governance process, disclosures, ESG compliance, etc., etc. So that will sustain the value of the company and give growth in the future. So strategic consideration, analyze the company and industry and its positioning, whether the company is performing well in comparison to other listed peers. Why investor should invest in this company without and not invest in an established listed company of the same industry. So that decision is very important, and that's why it is important to consider which industry it is falling, what is its positioning as compared to others. Then corporate structure and financial positioning. So corporate structure should be robust, as sir has clearly said. There should not be confusion. There should be pure clarity what the company want to do, what company is doing, what company want to do after IPO. There should not be complicated structures like brand is with some other person or promoters. Business is part of the business is dependent upon another group company or related party, or there is backward forward integrations, a lot of interrelated party transactions. Those things should not be there. Then there should not be internal competition among the group entities. These are total no for the investors. Then present infrastructure and for listing. So infrastructure includes governance process, systems and processes in the financial side, systems and processes of operations, IRPR capability, team, professional team which is managing finance, account, compliances, disclosures, etc., etc. So for that, all the infrastructure should be ready, and the business strategy, what the company would like to present itself as, and what will be the growth plan which it will disclose in the offer documents. Those are very, very important aspects which need to be prepared, and accordingly actions should be taken. Then health check need to be done, which includes corporate structure, as I have discussed already. Then capital structure, what is the size of the capital at present? So if we are talking about main board IPO, what should be the reasonable equity size of the company? Whether there is any convertible instruments, those need to be converted into equity at the time of filing of offer document. Then equity size should be reasonable, so that sufficient EPS is earning per share can be arrived, and that can grow year on year basis or quarter to quarter basis as post IPO, so that the valuation is justified. Then if required, there may be some requirement of doing financial re-engineering, like maybe some split of the company, some shares capital, maybe paid up capital may be enhanced by giving bonus shares, or some instrument like split of the companies per share, so that per share price is right for the market. Then governance, risk and compliance audit need to be done, and systems must be made robust. Compliance management system should be there. Then IRPR management system should be understood, checked, and prepared for. Then based on the findings of the health check, necessary actions, corrective actions need to be taken. And this is the longest time consuming process. So if we want, let's say there are certain business which is not performing well, and it is dragging down the EPS of the company or profitability of the company, they may need to be shifted from the company, hived off from the company. Then there may be some group companies or related parties which are regularly acting in the company. So there may be need for merger or consolidation of those businesses. Then there may be need for changing the capital structure, paid up capital enhancement, all those steps one by one to be taken. And obviously related governance related structure, appointment of necessary professional at various places, etc., need to be done. And then formal IPO process would start, where appointment of intermediaries, etc., would be done. So readiness process, business plan, financial side, if we are talking about business plan, should be ready. Whatever the fund company is taking in, where it will be utilized is very important aspect, and it is tested by merchant banker, and then it will be tested by SEBI, and it will be monitored also. So it is very important what is the fund requirement, for where it will be deployed, what will be its benefit to the company. So those disclosures, those finalization is very important. After finalization of preparation of the company's structure, internal process, internal business plan, etc., it is the time to search for the selection for the right intermediaries. So first and most important is the merchant banker. Besides that, the legal advisors, internal advisors, etc., and many other intermediaries are appointed, or consultants are appointed at a later stage, like RTA, for demat sales management, PR agency, IR agencies, etc., which can help in getting the right valuation. Then the process of actual preparation of the offer document starts, where merchant banker has its own role, legal advisor has its own role in drafting. Then there will be a need for industry research report, so that those parts can be incorporated. Then the role of the auditor, which has experience of handling the listed companies matters. A lot of hundreds of certifications are required from professionals like auditor and other chartered accountant, company secretary, etc. So those agencies, those persons need to be finalized. And then comes the time when valuation and price determination starts. So valuation is very important. One is the valuation of a company as a whole, and another part is what should be the right price at which the issue should be opened. So right pricing is also very important. If we are keeping the price of a company very high at the time of IPO, there may not be many investors, or there may be lesser liquidity in the market. So there may be certain limitation in the investors. Whereas if the price is very attractive, really reasonable, sometimes people does not go into the fair valuation aspect of the thing, but see that this is a small size shares they can invest. So it is also very important, especially in case of SME IPOs. Pricing per share is very important because per share price helps in attracting the smaller size investors. So these are the broader aspects for the readiness of the company. And if we go deep into it, each aspects, at least the beginning part, which is the creation of the right corporate structure, right capital structure, would be taking the highest amount of time. So obviously, other things relating to legal aspect, eligibility criteria, etc., I think it will be elaborated in detail by Ruchika, and the governance aspects and the how to manage the compliance and disclosures at a later date, and what are the precautions there would be discussed by Ankit in detail. So I'm not touching upon him. So I think from here I would like to hand over the thing to Ankit. Ankit, I think, would take it from here. Thank you very much.
Ankit, now you cover the because I had discussed that whenever a company is coming out IPO, then the governance aspects and disclosure aspects and compliance aspects is also one of the very important part. So please highlight all these points.
You are mute.
Yeah, carry on.
No, you are not audible.
Ankit,
you are not audible.
Am I audible now?
Yes.
Okay. So good evening, everyone. And so while we are discussing how to plan for an IPO as per the today's topic, but I think for a listed company, the real games begins once it gets listed. So we usually tell our clients who are going to a list for a listing that once you get listed, you are like a khuli kitab, and everyone is watching you. Whatever you are doing is subject to public scrutiny, regulator, SEBI, stockholder, shareholder, stakeholder, analyst, investors. Everyone is watching you. So what is important is in terms of how you prepare yourself to live the new phase of a listed entity, and where the word corporate governance plays a very is the mantra for listed entity. We every time we come and we hear something about listed entity, corporate governance is something which comes to the mind as a foremost thing to be looked into. And while it's very difficult to determine or establish what per se corporate governance is, but I believe in terms of the listing regulations, it outlines corporate governance in both in terms of letter and spirit. So if you're planning planning for being a listed entity, in terms of starting with what you need in terms of letter, as to what is there written in the regulations very clearly, that you should be prepared for a listing and the corporate governance changes that you need to bring in. So that starts from first of all from the constitution of the board, which includes the appointment of the independent directors and appointment of women director. So independent director selection itself is an important role, important process. Board needs to clearly outline and understand the requirements and expectations from the independent director, and then accordingly create a profile in terms of what kind of qualities, features, expertise they're looking for, and then they begin the search for the independent directors apart from the women director. And once the directors are onboarded, then the process starts for constitution of your various committees in terms of audit committee, remuneration committee, stakeholders committee, and their charter. While it seems easy to say that easy to have a charter for a committee, the regulations outlines the charter, but the charter are also important in terms of how the company wants to operate and how the company wants their committees to operate. So then each committee will deliberate on its own charter, define what it wants to do in terms of the terms of reference that is outlined under the LODR regulation, Companies Act, and what the independent actors thinks fit for the committee to look into. And then you have to draft all those statutory policies which are required as part of being listed under the LODR regulation. There is a whole list of policies that the company needs to adopt, primarily which includes policies on insider trading, policies on disclosure, policies on materiality of related party transaction, policy on preservation of documents, policy on your material subsidiaries. So there is a whole list of documents you need to work on and create and finalize all those policies, which should be ready when you are going up for an IPO. Then once these things are done, as I mentioned, that there is a fundamental change in terms of being an unlisted and unlisted company. It's actually a different ball game, and once you become listed, the overall attitude, how you approach things, all these needs to go a very seesaw change in terms of your approach. So therefore, it is also very important to set up the regulatory framework in terms of starting with financial results, because as a listed entity, you would be putting quarterly financial results every quarter, and then these will be consolidated in case you have subsidiaries and associates, which you are otherwise not doing. So you need to make sure that your accounts team are in sync with what is the requirement. Your subsidiaries and associates are in sync with the requirement of submitting the quarterly results. They have to be prepared. Then compliance management, SEBI LODR regulations, PIT regulations, all these outline a detailed list of compliances which a listed entity is bound to undertake during the course of time. And these compliances are not as in case of a unlisted company, which are mostly event based. In case of a listed companies, there is a strict guideline in terms of your quarterly, half yearly compliances which are outlined under the LODR regulation. So you have to prepare yourself, identify all those compliances, create necessary teams, allocate responsibility in terms of what needs to be done, who would be doing what. And all these compliances are very important. There are recurring penalties in case you fail to do so. So therefore, it is important that you have system in place in order to capture information as required for multiple departments in case. And there has to be sync with all the key departments in the organization that work along for ensuring these compliances are in place. Then investor grievance is another important thing, because once you go listed, there are lakhs of investors in the company who have their own grievances. They keep on asking you different things, filing complaints, and handling of investor grievance is something which SEBI takes it very seriously. So as a listed entity, you're also required to submit a quarterly return in terms of your handling of investor grievance. So there needs to be a separate team and protocols and procedure as to how the grievances will be handled, because they form a very critical part. And higher list of pending grievances entails that a company is not looking into the concerns of its stakeholders, investors, and which is not a positive signal for the investors. Then insider trading, fundamentally the most important change that you foresee as being a listed company is to be ready as an insider trading. And why it is more important, because generally in case of a corporate, in terms of compliance, finance, and secretarial and legal, these are the key teams which operates and work under the ecosystem. But when it comes to the insider trading, it encompasses an entire set of teams working in the organization, which needs to be taken account, and they need to be sensitized, trained as to what is insider trading, what they can do, what they cannot do. You have to set system and processes for trading by your employees, identification of your designated person. That itself is a very important task. You need to work on identifying who are the key employees who have access to UPSI apart from the list of employees that is mentioned in PIT regulations. So identification of this designated person is itself is a lengthy exercise. You need to ensure that all those who have access is properly covered and they are being properly sensitized in terms of the role that they play under the PIT regulations, and the kind of restraint that all the employees, DPs, directors, everyone has to follow in terms of the trade with respect to the company, how they handle UPSI, unpriced public sensitive information. That is very critical because you had to set proper barriers in terms of flow of UPSI between department, between teams, between you and outsiders. So all these systems needs to be in place. You have to ensure that all your vendors with whom you share UPSI, consultants, there are NDAs in place for those engagements. If they are not in place, you have to ensure that all those NDAs are executed. So insider trading itself is it's a separate ecosystem under which a listed entity works, and you leave aside LODR and every other things. The insider trading itself is a topic which you can discuss and detail and length, and where company has to be very vigilant in terms of the policies and protocols that they create. And because all these non-compliances has to be reported to the exchanges, and they also are subject to penal action by the board, or in case by SEBI, in this they go for adjudication. So that is very important. Then subsidiaries is another important thing, because there is a concept of material subsidiaries. You have to have an independent director on those subsidiaries. Then there are certain restrictions on those subsidiaries. There is a requirement of secretarial audit for those subsidiaries. So identification of material subsidiaries is also important to bring about the change in terms of the compliances that they need to undertake as being the subsidiary of the listed entity, something which needs to be taken account. Communication is very important, because as a listed entity, whatever you communicate to the market reacts. So it is important the communications team, the PR team are in sync. They are as to what needs to be communicated, what needs to be disclosed, as and when. There are a lot of events where disclosure is required. So the hierarchy should be very clear in terms of who will identify the events that needs to be disclosed, how the flow of information will take place. So all these things needs to be settled as part of the process of communications, disclosures. These are very key element. Any key, it has both positives and negatives attached to it. Any key non-disclosure of any key event can entail heavy penalties, and market may also react negatively on such information as it came into light at a future date. So we have to make sure that all these systems and processes in terms of our disclosures and communications are in sync. Then related party transactions under Companies Act, and in terms of LODR, the listed entity, there is a complete sea change in terms of how the framework work. The regulator itself, the stakeholders, they see related party transactions as something which is very sensitive, and they continuously watch these transactions. There are disclosure requirements, approval requirements of shareholders, audit committee, and then as part of the quarterly CG report, you have to give disclosures in terms of compliance of related party transaction norms. So, and one thing is also very important in Companies Act, their list of related parties is very limited in terms of clause 76 of section 2. While under the SEBI LODR regulations, it includes Companies Act, accounting standards, and then last couple of years this definition has also been widened enough to cover shareholders holding from April 23. It will be any shareholder who's holding 10% will be treated as a related party, promoter group. Even transactions of your subsidiaries will also be covered to some extent. So apart from insider trading, related party transaction is something which is very important, and for which there needs to be a very separate framework and very detailed coordination between the secretarial and finance team, because all these transactions will need prior approval in terms of general approval or omnibus approval, and there has to be sync in terms of both the departments to ensure that the flow of information is fine. And then risk management is also important as a listed entity, because LODR gives it quite emphasis to the risk management as being a listed entity, using public money subject to public scrutiny. Risk management is also an area where the company needs to work very closely, though there is also requirement of appointing risk management companies, certain class of companies, listed entities. But per se, risk management is also something which is looked into very critically by both the regulator and the stakeholders. So these are something which are highlighted as part of the letter. Now, when it comes to spirit, as I mentioned, in terms of spirit, it's not very easy to define corporate governance. But where I can help you is in terms of if you look into the principles that are enumerated under LODR, principles of disclosures and other obligations, that details out a very key detailed list of in terms of responsibilities of the board, responsibilities towards equity shareholders, principles regarding disclosures, all those things. If you comply those principles in spirit, I believe you would be a much better governed company, and your governance level would be at a much high level, because otherwise it's very difficult to establish what would be corporate governance. But these principles are playing very important part in many adjudicating orders of SEBI. SEBI have been relying on those principles in terms of treating them any violation of those principles as a violation of LODR regulations. These principles are can act as a torchbearer for you to highlight what needs to be done in terms of corporate governance. And while all these in terms of letter and spirit, it is very important that the board should be sensitized in terms of his responsibilities as a listed entity, his role in ensuring corporate governance norms are duly complied with by the company, both in letter and in spirit. So it is also important that just either before listing or close to listing, sensitization programs are being organized by the directors to make them aware of their responsibilities, roles, and functions, both as non-executive or executive directors as a part of the listed entity. So I think these are some of the key things one needs to take care while they work on defining or creating or implementing a corporate governance framework in the organization. And I'll leave back it to Pavan sir to take it forward.
Okay, thank you, Ankit. Thank you. Nicely presenting views that what important thing everybody should do. Now, Ruchika, you have to tell the basic criteria issues relating to IPO. Over to you.
Thank you, sir. Thank you for giving me an opportunity to speak on the webinar. And I would like to share my presentation here. So, good evening, everyone. As the speakers before me has touched upon the global trend, the number of IPOs which has come in past, the trend of oversubscription by the investors, and the critical aspects of what all things need to be taken into consideration for coming an IPO, I would like to re-quote again the 3R parameters, which was mentioned by Mr. Manoj Kumar, that the right timing, realistic valuation, and the robust financials are the most important parameters for planning, for even making the strategic consideration in IPO planning at the very first stage by the management before checking any other parameter for the IPO. So, as considering all these scenarios, exchanges over the time has laid and has come out with a lot of regulatory changes and has introduced platforms where the companies can seek listing. So for the companies who are closely held and who wants to get listed on exchanges, there are broadly 3 platforms. One is the main board, where any sizable company can go for listing on the main board of BSE or NSE. The other are 2 platforms which are made for small and medium enterprises. For BSE, it is SME exchange. For NSE, it is Emerge. So, considering that we have seen that generally the IPOs in the main board segment has a pre-money valuation of 1,000 CR and above. And for the IPOs in SME areas has a maximum post-money valuation of 400 CR. These are the numbers which I'm quoting from the trend which we have seen in past. So considering these trend, it is very essential for those small companies also to get an opportunity to migrate themselves to the main board. So exchanges have come out with a lot of basic conditions which, if complied by the companies who have been listed on the SME exchange or the NSE Emerge, that who can come on the main board of their own exchange or on the cross exchanges. So we'll discuss all those conditions in the latest slides. These are, as I mentioned, these are the 3 platforms where any closely held company can go and can get listing of their shares. Now, I would like to touch upon and I would like to discuss 3 major points which need to be considered while doing the strategic planning for IPO, which is the entry barriers which are given in SEBI ICDR regulations for companies who are planning to coming out for IPO. some eligibility criteria which should be complied for either the fixed price issue or the book building price issue, and some major conditions which need to be taken into consideration at the time of planning only. I would not touch upon the legal process of how the IPO runs and how the entire process gets concluded, but there are certain conditions in the law which you need to take into consideration at the time of planning for the IPO only. So coming upon the entry barriers, at first, for the main board and for the SMEs, there are 4 basic conditions which every entity shall comply with. Number 1 is with respect to debarment from assessing capital market. So if any issuer company, its promoter group, directors or selling shareholders in case of offer for sale IPO, if they are debarred from assessing capital market, then they cannot come out with an IPO. The other condition is debarment from assessing capital market of any other company in which the promoter or director of the issuer company is either the promoter or the director in that particular company. So if that company is also debarred, then also the issuer company cannot come out with an IPO. If the issuer company, any of its promoter or director is a willful defaulter or fraudulent borrower, then also they cannot come out with an IPO. And if the promoter or director are fugitive economic offender, then also they cannot come out with IPO. So these are the basic entry barriers which every entity shall check before planning for the IPO. For the purpose of debarment, SEBI has carved out an exception that if the period of debarment is over, then probably they can come out with IPO in the forthcoming years. Let us say any person or any company was debarred till 2022, then of course they can come out with an IPO in 2023. That relaxation is given by SEBI. There is one additional condition for the entry barrier for the purpose of main board IPO, which says that if an issuer has any outstanding convertible security or any other right which would entitle any person to receive shares in the company, they cannot file DRHP with SEBI. The only exception to this rule is that you have to make those outstanding convertible securities as fully paid up, and you have to undertake that those convertible securities would be converted into equity shares before filing of prospectus or red herring prospectus, as the case may be. Then only you can file DRHP with SEBI. And the other exception is with respect to ESOPs. If any options are granted to the employees of the company, whether present or whether future, then on the basis of that, exemption is there and you can file DRHP with SEBI. So these are the broad conditions, broad entry barriers for the main board companies, along with SME companies, which I've captured in the last slide. Now I am touching upon the eligibility conditions which are there in law. So these eligibility conditions are only for main board companies. It says that a company having net tangible asset of at least INR 3 crores in each of the preceding 3 full years would be eligible to make IPO, and not more than 50% of which shall be held as a monetary asset. So those companies who have net tangible asset of more than 3 CR in 3 full years can go for IPO. The company should have average operating profit of at least 15 crores in the preceding 3 years. So this average operating profit can be calculated in a way that in financial year 20, let us say the operating profit was 10 CR. In financial year 21, the operating profit was 20 CR. And in financial year 22, the operating profit was 15 CR. So on an average basis, it has to be minimum at least 15 CR. Then the company would be eligible for IPO. The third condition is having the net worth of at least 1 CR in each of the preceding 3 years. And the fourth condition is if there is any change of name in last 1 year, then at least 50% of the revenue shall be from the new activity which has came into the company pursuant to the change of name. That should be there. So all these conditions which are there under SEBI ICDR regulation should be complied for coming out with a fixed price issue. If any of the condition is not complied, then the company has to come out with a book building process issue, which is laid down under regulation 6.2, and in which you have to allot at least 75% of the net offer to the qualified institutional buyers, And in case the offer is not fully subscribed, then the entire money shall be refunded back to the QIBs. So these are the eligibility conditions for main board IPOs. Now coming to the eligibility conditions for SME IPOs. SME, I'm talking about SME on BSE as well as for NSE emerge. The conditions are that the company should be incorporated under Companies Act 1956 or 2030. The post-issue paid-up share capital shall not be more than 25 CR. The net worth of the company should be positive. And the tangible asset shall be of minimum 1.5 CR. This is only for BSE SME platform. And there shall be a track record of at least 3 years. Now, coming to this track record, there are various confusions in market that what would tantamount to the track record of 3 years. 3 years for BSE, the company proprietorship LLP should have a combined track record of at least 3 years. In case it has not completed its 3 years track record, then it should be funded either by bank, financial institution, central or state government, or the group company of that particular entity which is going for listing on the SME should be listed either on the main board or on the SME board of BSE or NSE, as the case may be, for at least 2 years. So these are the basic condition for BSE SME listing. For NSE, for the purpose of track record of 3 years, this track record can be checked for the listing the company which is getting listed, the promoter or promoting company, whether incorporated in India or outside India, the proprietorship firm which is subsequently converted into company. So the track record of the proprietorship firm as well as of the company combined is to be checked for the purpose of 3 years. So these are the basic eligibility conditions for IPO on SME or for the small and medium enterprises on SME of BSE or emerge of NSE. Now, as I mentioned in my initial slides, if a company get listed on SME of BSE or on emerge of NSE, there is an option through which they can get cross listing on the main board of other exchange. Let us say company A is listed on emerge of NSE and now they want to get listed on BSE as well. Then there are certain conditions. So if they'll comply with it, then they can get listing. But before coming to the conditions, I want to touch upon that why generally companies go from SME to main board. So the benefits from going from the SME platform to the main board are that they'll get better share price, they'll get better liquidity, their market capitalization would be increased. The stakeholders and the investors who generally invest in main board are they are large in number as well, and they are majorly the larger shareholders in comparison to the pool of investors which are there in SME. So, and obviously they'll get better public reach. So these are some of the benefits which are there, because of which companies prefer to go from SME to main board upon satisfaction of certain conditions which are here. So paid up capital of more than 10 CR, but up to 25 CR is the eligibility condition. Market capitalization of minimum 25 CR, track record of at least 3 years, minimum listing period 2 years, net worth shall be positive. The company should not be in trade to trade group. There should be positive cash accruals. And also if automatically any company, breaches this paid up capital threshold of 25 CR, then they get migrated to the main board of their own home exchange directly. So that is also there, that provision is also there in the exchanges circulars. Now, as Manoj sir has already touched upon that how many types of IPOs are there in the market and how many types of IPOs have come, I would like to again just briefly come on these steps. Is number one is the fresh issue. Fresh issue is an issue where generally fresh shares are issued by the company and the funds which are received in the IPO are invested in the company for the object which has been laid down in the DRHP, which has been decided by the management for the business and for other general corporate purposes, etc. Second is offer for sale. In offer for sale, generally no funds are received in the company, and either the promoter is partially taking exit from the company, or the investors, private equity players who have invested in the company in the early days are taking exit by way of IPO. So that is the second way. And the third is a mix of fresh issue and offer for sale, which we have seen that a lot of IPOs have come in this format also in recent past. So coming upon IPO process, as Mr. Manoj was discussing, broadly strategic consideration and IPO planning is the first stage where you decide that what is the, whether your company is presently have the right time to plan for IPO, the numbers and the financial financial systems and the business plans are in place. Those are the strategic consideration, which is generally the management's call and is taken by the management of closely held companies to plan for IPO. And post to that, which is very important, not preferably done in all the companies, is corporate health check and readiness process, which is the internal health check by the company, by the internal team of the company, or with the help of certain professional experts, that whether the company, it is some sort of gap analysis where you assess that what you are and what you're planning to be, and whether you can that company or not, whether you have that infra, which Mr. Ankit also mentioned in his speech, that you should have infra for giving the financial results on quarter to quarter basis, and you should have the robust system for all the financial transactions which are happening on day-to-day basis. Because when you are unlisted, when you are closely held, you have to make your financial results once in a year, but when you get listed, you have to make it on every quarter basis. So all the things should be in place, designated persons who all are there, whether the policies would be there, whether your secretarial team is equipped to do all those activities which would be applicable mandatorily upon you post to getting listed. So all these are the basic strategic consideration. IPO planning, corporate health check are the basic parameters where you do all these exercise. And you also select some intermediaries. You make your mind that who all would be the intermediaries for the process if the decision for IPO is made. So once all this is in place, and once the management takes the final call, the IPO is rolled out, and the process for IPO is rolled out, and various intermediaries which were earlier selected, or the quotations for various intermediaries such as lead managers, syndicate members, industry research report creators, and PR agencies, ad agencies, legal counsel for the company, legal counsel for the bankers, banker to the issue, registrar to the issue. All these intermediaries are appointed on the stages basis, where as and when they are required. So at this stage, generally the company prepares all the data which is required to be given to the intermediaries, whether it is with respect to the business of the company, whether it is with respect to financials, corporate structure, past track record, management, risk factors. Everything need to be assessed by the company and uploaded in a virtual data room to be provided to the intermediaries to do the further action when they are appointed. So as and when intermediaries get appointed, they, even if company has done their past due diligence, they have assessed the gap, they have identified the issues, and they have done the corrective measures as well. But then also when the intermediaries are appointed, they do their independent due diligence of all the aspects which will go in the DRHP. Whether it is with respect to business, whether it is with respect to financials, corporate structure, everything is being again checked by the intermediaries. And once the vetting and all the process happens, then the drafting of DRHP initiates. And the DRHP, as broadly mentioned by the past speakers, covers everything about the company. It covers that why the issue is coming, what is the purpose for issue, what is the object for issue, how the funds which would be infused in the company, if it is a fresh issue case, would be utilized, how and when, what is the plan for utilization of those funds, and all those things are there. Then you have to make your specific business section as per DRHP, that what is your exact business, and when you'll go to file the DRHP, what would be your consolidated business which you want to portray. You have to identify your industry, which is very important. There are a lot of IPOs which are coming, and a lot of new industries are being emerged out of the mix of one or two. So that is all which has to be done by the company team with the help of various professionals at the time of planning for IPO, making DRHP, at the time of due diligence. So all those things comes into picture. Then again, the financial information, your statutory auditor also plays a very critical role in restating the financials for the DRHP. And then again, your non-business section, which involves a lot of corporate information, management information, who all are there on your board, what are their experiences, what are their past, like where they were earlier directors, and all those things plays a vital role, because as Pawan sir also mentioned is in plenary speech, that SEBI is very crucial nowadays in checking each and everything which is mentioned in the DRHP. And you are coming out with an IPO to raise fund at a right valuation, and your valuation is dependent upon what all things you have portrayed in your DRHP about your business, about the numbers you are mentioning about the past, and even the future plans which you can indicate a bit. So all those things forms part of DRHP, and then DRHP is created. Then of course the legal process, you file DRHP, you seek approval from regulator and stock exchanges. Then there are series of queries between lead managers and SEBI, and those queries are addressed. Responses are given. Once the public comments are also invited in this period. So the DRHP which you file with your exchanges, which you file with exchanges and with SEBI, it goes to SEBI. It is hosted on the website of SEBI. It is hosted on the website of exchanges, on the company, so that public can also read and give comments upon it. And once the in-principle approval is received from the exchanges to SEBI, then SEBI give their final comments post to receipt of all the queries, responses to the queries which has been raised by SEBI in the due course. And then this is the period where generally roadshows are done, where water testing is done for checking that what valuation your company is getting for the IPO. So this is the time you generally test the water, you do roadshows, you do marketing, and all those activities is done. Once the approval is received, then of course, you conduct investor and public relationship management, you build the order book, determine issue price, allocate orders, and then ultimately you get listed. So this is the broad process which is being followed by a lot of companies which are coming out with IPO. Recently, last year in November, SEBI has come up with an amendment in SEBI ICDR regulations, whereby they have introduced Chapter 2A. So all this provisions which we were talking about is for main board is covered under Chapter 2. Chapter 2 is additionally introduced, which talks about the pre-filing process for companies who are not very much interested in filing their entire DRHP on the public platform. So what happens generally, as I mentioned, when you file DRHP, it is hosted on the website for public comments. So I was just telling the contents of DRHP, which contains a lot of business information, a lot of information which if get public and if your competitors get to know, then it might be a problematic situation for you if you are ultimately not coming out with IPO. So SEBI has carved out a leeway period where you can file the DRHP with SEBI, which would not be hosted on the website of SEBI. Your all sensitive information would be confidential, would not be hosted on any public platform. And once you test the waters, once you test that the valuation is appropriate, is something which you are looking around, then probably you can finally again file the UDRHP, which is an updated DRHP with SEBI, and which would be hosted on public domain for public comments, and then your IPO would ultimately sail through and you'll get the valuation which you were looking for. So this is a very welcoming move, which we have seen a lot of companies have appreciated about it. And one case was immediately filed just after the amendment of this particular introduction of this particular chapter. The only thing is that the testing of waters, or getting the tentative range of valuation in this period is only allowed up till the qualified institutional buyers. You cannot do the entire marketing process. You can do limited marketing in this period. And one additional benefit is, as I was mentioning at the time of telling the eligibility conditions for IPO, that there should not be any outstanding convertible security at the time of filing DRHP. So you have to make them fully paid up. In this particular case, when you are going for IPO under Chapter 2A, then you can continue with the outstanding convertible security. You need not to convert it. You need not to take the balance amount from the investor for those securities. That only the undertaking to SEBI has to go, that in case you will proceed with the IPO process, then these would be made fully paid up before filing of the UDRHP one, which is the second DRHP, which would be hosted on public domain. So these are the indicative timelines, which indicative timelines of the process, which is there in law. Now, as I was mentioning earlier, that there are certain, checkpoints which company need to take into consideration at the time of planning for IPO. So some of them I have mentioned here. First is with respect to offer for sale specifically, which talks about that the securities which you want to offer in the OFS process shall be held by the seller for at least a period of 1 year. So you cannot come for an offer for sale issue unless the securities you want to sell is held by you for the past 1 year at the time of filing DRHP. So that is one of the critical condition that should be checked at the time of planning only, when the investors are let us say any investor has invested very recently in the company and they want to become a selling shareholder in the OFS, which the company is planning, then probably they would be ineligible because this particular condition is there. There are certain exemptions to this condition, which is with respect to if you have acquired certain shares pursuant to any scheme of arrangement where any particular unit was there in existence for more than 1 year, and pursuant to that business you have received those shares. And the exceptions are there for government companies, statutory authorities. There are certain exceptions in it, that if any shares are issued as bonus shares in last 1 year, so those are the exceptions here. So in this offer for sale, just talking about the threshold, if the persons who would sell, a person or the person acting in concert along with them, if they're holding more than 25% of the pre-issue shareholding of the company, then they can only sell 50% of what they are holding. So let us say if they're holding 30% of the pre-issue shareholding, they can only sell 15% in the offer for sale. If they are holding less than 20% of the pre-issue shareholding, then they cannot sell more than 10%. So this the offer for sale threshold of 10% would come upon them, and so these are the broad thresholds which are there in law for companies who are planning to come out with issue in as offer for sale. Now, touching upon other important aspect is with respect to promoters' contribution, which is also very critical to analyze at the time of planning only, which deals with that the promoter of the issuer shall hold at least 20% of the post-issue capital. So generally, you see in startups also, and when Mr. Manoj was talking about the life cycle of IPO, we saw that you get pre-seed funding, you get venture angel investor, you get venture capital, then private equity come. So a lot of securities are issued to them. And generally promoters holding, we have seen in a lot of cases that the capital of the company is really small at the time of planning. So you need to plan it very well, because if your capital is very small, then probably you would not be able to meet the 20% of the post-issue capital minimum promoters contribution threshold. So that is one critical aspect. And a lot of securities are ineligible to be considered for the purpose of this promoters contribution. Say if you have acquired any shares in last 1 year for consideration other than cash, so those would be ineligible. If you have acquired any shares, I'm talking about promoters, if they have acquired any shares in the last 1 year at a price lower than the issue price, then those securities would be ineligible. And of course, bonus issue, again, bonus is there, and the only exception given to the lower category is that if they are ready to pay the differential amount to the company prior to filing of DRHP, then the exception is granted. Again, the same exemption for government companies and for the companies, for the securities which has been issued pursuant to the scheme of arrangement, that exemption is still there. So this is also very critical to check while planning for IPO. Talking about lock-in of securities, this is also very important, because at times, there are angel investors who invest in the company, and in any company, you see there are two types of investors. One who are long-term, who want to stay with the company, want to grow with the company, and the other are who want to take exit either upon getting listed, as and when they can, at the earliest they can. So for those investors, this is also important to check that what are the lock-in provisions there in ICDR regulations. So for promoters specifically, if I talk about, so the minimum promoters contribution, which is 20% of the post-issue capital, shall be locked in for 18 months. And there is only one exception to it, that if the object clause, object of the proceeds which you'll raise is to be utilized for capital expenditure, then this 18 months will exceed to 3 years period. So that has to be taken into consideration. And for the remaining promoters contribution, the lock-in is for 6 months. For persons who are other than promoters, the lock-in is for 6 months from the date of allotment in the IPO. So the exception is granted to employees.
Ruchika, your voice is...
Or to the venture capital fund or alternate investment fund to whom the shares have been allotted. For them also there is an exception carved out in law. So broadly, these are the major checkpoints which any company has to take into consideration while planning for IPO. And all your business should be your definition of what all falls into your business and in which industry you are falling specifically. There are a lot of companies who are doing various activities, so they need to specify that in which industry they would fall, because ultimately the valuation you will get only upon the industry you will classify into. A lot of queries have been raised by the participants that upon which which is the factor basis upon which you'll get the valuation. So talking about manufacturing companies, it is different. Talking about service companies, it is different. But ultimately, you need to identify that where you are, in which industry you are, and your numbers should be robust to assess that what value you would get in IPO.
Okay. Thank you, Ruchika. Thank you for giving the detailed analysis of your... So now I have received various questions. So I'm asking some questions. Somebody is asking, how can we get an idea that how much valuation our business is going to get post listing in the IPO? No, this, Manoj, you have any view on this? So friends, the valuation aspect depends upon your business, because sometimes your business is robust and the future projection or the DCF method is very attractive, you can get more valuation. It is not the tick box policy. Manoj, you have any point in this relating to valuation, post-listing valuation?
Manoj, you have to unmute.
Yeah. So post-listing valuation, valuation is obviously, as I have discussed, if we are benchmarking the company with some peers, then we need to keep some leeway, some gap, some value for the investors. Then only it will grow. So that is very important. What is the right price at which and right valuation at which you come out with the IPO? If we are taking the fair valuation, let's say in comparison to the other listed peers, and keeping that as the issue price, then there is no hope for further immediate gain or immediate post-listing increase in the market price of the company. So in such cases, obviously there is a huge risk of first day selling and a price fall. But in all other cases, obviously, if you are keeping some leeway, then there will be growth. And obviously, if the business plan is robust and fund is coming into the company, market capitalization should increase, considering the strength of the management and the growth.
So the point is that if you are bringing out IPO, then you should not take away entire valuation. You should leave it for the investors also. And if your company is new one and your peer is established one, then why I should invest in that company? So you should understand the investor is taking in risk in your company, which is new one, and then you are charging the higher rate as compared to your valuation, then you will not get better. And once you are out of track, then nobody will help you in future also. It takes too much time. So the best advice is that you should keep something for investor and then you can grow. Now, Manoj, I have various questions people are asking. One question relating to valuation. So I'm advising everybody that whether you are coming out with IPO or not, that's not a question. There is a system of doing valuation of your business. So you can do the valuation of your business by the registered valuer or those who are in valuation business. And then you just analyze whether your expectation is meeting or not. If it's not meeting, what is the reason, how to improve this, that you do it. So self-valuation is one of the good aspects if you are going that this is my valuation, how to improve the valuation and how much I have to reach when IPO will come. So this is the best way you do it. Now, how the following action of the company can be planned? Planning of pre-IPO investor and anchor investors, whether convertible preference shares before IPO and the conversion of the same into equity share just before the filing DRHP is wise action from such company. Manoj.
So Ruchika has clearly mentioned there is a requirement for as a eligibility criteria that all the convertible instrument must be converted into equity at the time of filing of DRHP. However, there is an exception if those convertible instrument is made fully paid up and a commitment is given that before filing of the RHP or prospectus, as the case may be, you are converting it into equity, then it can be done. Another option which is recently come is in the form of pre-IPO pre-filing of IPO document. Here there is no need for conversion of all the convertible instrument. Neither there is a requirement to put the money 100%. So here, if you are if you have investors in the form of convertible debt instrument or convertible preference shares, and you want to test the market whether market will allow will accept the IPO or the capital market regulator will allow this IPO to go ahead, then it is better to pre-file and get the clearance from SEBI, and then at the time of DRHP you get the conversion done. So that is the way.
Okay. What will be the tax treatment under section 56(2) subsection 7 if in pre-IPO company issue shares on preferential basis at premium while such company was private limited company in the hands of company?
So yes, sir.
Change in tax treatment if such private limited company converts into public limited company and make preferential allotment of shares before IPO to certain categories of persons.
So as per income tax 5627B is applicable to all companies other than listed companies. Listed means the company which are regularly quoted in the market. So in all such cases, if the shares are issued at a price higher than the fair value, then the difference will be considered to be the additional premium the company is getting will be deemed to be income, current year's income. The exception has been given in the section itself that in case of startups, this law will not be applicable for certain period. So, and that period is on. So only for those exceptions, in all cases, if whether the company is a public company or a private company, if they are issuing at a premium higher than the fair value, then it will be a taxable event in the hands of the company.
Okay. Underwriting process and valuation of SME IPO company.
Underwriting is a method where merchant bankers give commitment that in case there is no participation of the public in the issue, they will subscribe to the unsubscribed portion. So it is all SME IPO need to be fully underwritten. The underwriting can be done by the lead manager and along with some syndicate member which are registered with SEBI as a underwriter, SEBI registered underwriters. So here they give guarantee that in case there is no subscription from the public, they will subscribe to the share. Obviously for that they are taking that risk, so they will charge fee, and the fee will depend upon the pricing at which issue is coming and the risk of non-subscription, etc., etc. So there is no ballpark figure we can give here.
Okay. What is the role of market maker in SME IPO?
Role of market maker is to ensure liquidity. In case of SME exchange, the criteria of investor is the minimum ticket size is 1 lakh rupees. So if so, there can be a situation where there is no buyer or no seller for the company, and someone want to exit from the company. So the law says that there should be a market maker for at least 3 years in case of SME exchange listed company. Sorry.
What is the fee? Market maker's fee.
So there is the brokers are appointed through merchant banker as a market maker, and their fee varies depending upon the risk of downfall in the price or demand for buy or sale from the company. Depend upon that they decide what should be the right fee. But
Okay.
it is
Accepted multiple of net profit for considering a fair valuation of a company.
So as we have discussed, there is no fixed criteria, no fixed valuation parameters for each industry and each company. There can be a company which is even a loss making, like we have seen in many of the startups which have come out with the IPO. There is no visibility of profit, and still the valuation has been determined. And they have got even better valuation in past when private equity funds have put money into it. So based on that, they have decided what will be the future earnings, let's say after 3 years or 2 years down the line. And based on the valuation has been done. So various other factors have been considered, that the market penetration, number of subscribers, growth, which is happening in the top line, etc., etc. So based on that, they have decided now.
Okay, roughly, a company can raise how many times of its net worth?
There is no such criteria as such.
Okay, so you can bring out because it's open market and you disclose.
Only requirement, as Ruchika said, 1.5 crore positive net worth is the condition. So that is very small, and besides that, obviously you can come out with IPO which is 100 times of net worth. That is also possible.
As a merchant banker, you please tell what are the costs of the SME IPO and main board IPO roughly?
Cost, sir, that is very difficult. It totally depends upon the situation, company to company. But the process cost, if you say in case of SME IPO, the process cost, regulatory fee, etc., collectively will be in the range of 40-50 lakh rupees. And main board, it depends. It may be 6%, 4% to 12% of the size of the issue. But there is no fixed criteria for that.
There is a fundraising cost, huh?
Many of the costs, all the intermediary costs, SEBI fee, and fundraising cost, syndicate members fee, etc., etc.
And the issue size is more, than cost will be reduced.
Yes.
Okay. Order in hand with the company need to value while going to IPO? If yes, then how?
There is no such criteria, as we have said. Some companies valued based on their assets, some companies are valued based on the order book, some companies are valued based on the market penetration, number of subscribers, number of investors, etc., etc. So profitability, EBITDA multiple. So valuation is a very subjective thing, and we have to see the peers, see the industry, what are the reasons of anything to happen. So based on that, decision is to be made.
How to decide promoter group through in the company act MGT 7 did not mention the name of the promoter.
So if MGT7 is not mentioning, then we have to test the other two criteria like control, board control, capacity to control the board and decision making, and the person who is willing to be acting as a promoter. But there can be a situation there where there is no promoter. There are many of the companies which are coming out without any determined promoter. So they are called professionally managed company, and that is also a possibility. However, and regarding the promoter group, if we determine the promoter, then there are list of persons who would be deemed to be a promoter group person, and the rest of them. So based on that, we will test it.
Okay, Ruchika, what is the time involved for IPO for a company at main board and SME board? If company are more than 3 years operational track record.
So for main board, if the company is appropriately ready, then also, as you also mentioned in your initial speech, 9 to 12 months. And for SME, I would say 4 to 6 months is fairly the reasonable time for IPO.
Okay. Why is the required to give top 5 suppliers revenue in the draft prospectus, Manoj?
Sir, there is no, sir, these are the information which are given for justification or giving transparency about the business aspect of the company. So if we see that top 10 suppliers and top 10 buyers are constituting, let's say 90%, 95% of the business, then the risk increases. Any of them getting out, it may dip the top line of the company, or it may risk. So that is risk need.
Suppliers from China.
Yes, there can be. Yes.
Ruchika, what if promoters group denies to give pen in the draft prospectus?
They cannot deny, so they have to give the PAN as per mandatory requirement. They have to disclose it.
If the person is ready to be disclosed as promoter, he has to take all the onus and sign. So
if the person is from international, say foreign person.
So then any tax residency certificate number would suffice the purpose.
Okay. What is a confidential filing of DRHP?
Confidential, sir. I think Ruchika has explained in detail this new provision which has come.
Okay. What are the role of KPI and their impact on the company?
So KPIs are key performance indicators, which are generally given in the DRHP also, because it indicates that how your company is running, what are the basic business parameters upon which your company is running, and how you are seeking valuation in the IPO. So those are KPIs.
Okay. Ruchika, any person, body corporate, holds more than 20% in stake, the proposed IPO company will be classified as promoter?
Sir, if that person wants to classify as promoter, then that entity would be, but otherwise there is no assessment.
If you are holding, it's not compulsorily making.
Yes.
Okay.
Yes.
After closure of the list auction, we are now registered to MSME. Can we migrate to SME platform?
MSCI it is.
Yes.
SME IPO, SME board is not, there is no provision of cross shifting to SME board. It can go to the main board of PSC or NSC.
Okay. What is promoter contribution for SME IPO?
It is the same for in board and SME IPO.
Right.
Minimum 20% of the post-issue paid up capital.
Okay. Is there any exception to the condition of AOP criteria of 15 crore for the main board listing?
Average operating profit of 15 crores. So yes, if, as I mentioned in my speech, that if you're not qualifying with that criteria, then you'll go in regulation 6.2 IPO, which is book building issue. And there you have to allot 75% to the QIPs. That is the way through which you can get listed.
Okay. Are promoter share compulsory in demat mode? Answer is yes.
Yes.
At the time of filing, DRHP has made an application for demat, but current status, physical yet to be dematted. Please clarify this.
I don't think it is possible to keep the shares in physical form at the time of IPO.
Okay. A broking company which is listed at BSE and invested more than 65% in subsidiary company Now, the subsidiary company is incorporated in the year 2022 and dealt in green energy business. Whether shares of subsidiary company can be listed directly at BSE stock exchange without issuing shares to public through IPO. The objective of such direct listing is to give shares to subsidiary company shareholder of the main company in their respective ratio.
Yeah, so it is a matter of restructuring. If we come out with a scheme of arrangement under which the shares would be distributed among the shareholders, then exemption under 19(2)(b), Rule 19(2)(b), a CRR can be sought and a company can be listed. However, there may be a challenge of this scheme to be considered to be a demerger, because there is no undertaking which is getting hived off from the company. So tax consideration has to be taken care of. Otherwise, listing is possible.
Okay.
So
Through 19(2)(b) route you have to go.
the scheme of arrangement route, yes, through 19(2)(b) we can go.
So I have to go to NCLT also.
Yes, first stock exchange SEBI, then NCLT, and then finally back to SEBI.
First I have to go to stock exchange, then approval of SEBI 19(2)(b), then NCLT. Okay. Why the market listing price is less than IPO price? Will it send wrong signal to the investor?
Obviously, many of the investors are investing in IPO to get as IPO gain, listing gain. So if the price at which the company is getting listed is less than the issue price, there will be a loss to those shareholders, and they don't want to stick with the company for longer. So there may be a wrong signal, and there may be heavy selling of the public shareholders, and which will cause fall of the price.
Okay. Is bonus share issue shares during the preceding year eligible for minimum promoter contribution as per section 237(1)(b)?
Yes, I think Ruchika has already explained this.
Yes.
If the company allot the shares under private placement basis on valuation report, which is generally based on book value prior to IPO, would it have any impact on the price at which shares are to be offered in IPO?
There is no direct correlation between the issue price prior to the IPO and the post IPO, except where we are talking about offer for sale, or we are talking about promoters' contribution. For rest of the things, there is a requirement of disclosure to the in the offer document that promoters have got, or existing shareholders have got a share at X price and issue price is Y. So there is a difference, and investors can take shares on informed basis.
Okay. How much amount raised through an IPO can be utilized for general corporate purpose?
Maximum 35%.
Okay. Can existing shareholder offer their shares in IPO instead of fresh issuance of securities by the company?
Existing shareholders?
Offer their shares in IPO instead of fresh issuance of security by the offer.
Yes, offer for sale is possible. Yes, all kind of shareholders which are eligible can be tendered.
What is minimum subscription criteria in IPO?
Minimum subscription. So 90% is the minimum subscription.
But the amount is, if the higher value is there, then it's reduced also.
So yes, if the post pre-money IPO size is more than 1600 CR up till 4000 CR, then the threshold is different, and then the criteria is different for minimum subscription as well.
Okay. Okay. What is if the company is not satisfying the eligibility criteria, can it still go for IPO?
Yes, as Ruchika has explained, again, it is the repeated question, same question.
Okay. If a company is going concern since past 7-8 years and is required funding, then how shall it decide between private equity and IPO?
So as I discussed, if we want to go for IPO, we have to see regular growth, consistent growth performance, and the stage of the, obviously, maturity of the business and maturity of the organization. If that is the case, then IPO is the better route. Because there will be no obligation with respect to a special rights to be given to a one person. It will be mass which will invest. Otherwise, private equity could be a good idea.
Okay. Liquidity is one of the benefits of IPO. What I see many listed companies have less or no trading.
Yeah, so there are thousands of old companies which are listed on stock exchanges, where many of the shares are still in physical form, which cannot be traded on the stock exchange. So that is one of the very important reason for illiquidity of those shares. Besides that, obviously, if the company is not performing well, nobody is interested in buying or selling those companies' shares. So such situations are there in many of the cases, old company.
Okay, Ruchka, whether promoter locked in shares can be transferred?
Sir, inter-se within the promoter is allowed.
Okay. Okay.
And so there are certain circumstances like takeover offer is coming, then those shares can be transferred as part of the deal.
Okay. Manoj, in what case we shall not opt for IPO over other source of funding?
If you are not willing to be more transparent, take obligation of the compliances, higher level of compliances, higher governance principles, then it is better not to go for IPO.
Okay. Some suggestion is this: please come up with a webinar for process of raising fund through preferential issue after listing. Okay.
Okay. Yeah, we will consider. Certainly, it will be good idea.
Is underwriting mandatorily done by merchant banker for main board listing as well?
In case of book build issue, it has to be underwritten. So obviously, merchant banker is the first one who need to underwrite, but he can take support from underwriters which are registered with SEBI.
Okay. Can the market maker for SME company play mischief with the share price? Is the promoter responsible if any action from SEBI is initiated?
Market makers are regulated entities. They are registered with SEBI. Generally, they are the brokers who are registered with SEBI, and they have their own obligation and they have to make disclosures. So if they make some mischief, it will be considered to be fraudulent and unfair trade practice, and they may be prosecuted separately.
Can you give some idea on trading in unlisted space in the pre-IPO phase?
Sir, there is a practice of gray market, but they are not official. So obviously, we cannot discuss that anywhere. So there are certain persons who are willing to buy or take bet on the post listing value of the company, and based on that, they try to buy the shares. But there is no official market for unlisted shares.
How the syndicate member is different from self-certified syndicate bank?
Self-certified syndicate banks are the persons who collect money on behalf of the company. So the ASBA or UPI or whatever the methods are available, they collect the money from the investor and they accept the applications for the issue.
Whether the pre-IPO placement made just before the IPO form part of the 25% dilution required, or whether the IPO itself need to be at least 25% of the post-IPO capital.
Only anchor investors who invest one day before can be counted towards 25% minimum investor. Rest all has to be part of the 75% only.
Okay, is listing takes place first or IPO, or it is a simultaneous process? First IPO, then listing. Okay. If the company allots shares under private plans based on valuation report, which is generally based on book value prior to IPO, would it have any impact on the price of which shares are to be offered in IPO?
I have already discussed. It has no offer reason to. The valuation is not a not a hindrance. It is only about the disclosures. Only hindrance can be if the allotment these shares need to be part of the promoter's contribution. In that case, the differential value has to be brought in by the promoters.
Okay, is bonus shares is bonus issue shares during preceding 1 year be eligible for minimum promoter contribution?
Yes.
Okay. Allotment made during preceding year other than cash, but revaluation of asset or capitalization of intangible assets does not involve in the transaction. Will it be considered a minimum promoter contribution?
No.
Consideration other than cash, if it is not out of revaluation reserve or capitalization of non-cash profit, can be considered.
Okay, is it advisable to go for IPO to reduce loan? Debt-free company will have to better valuation, reputation in share market.
That is not the case. We have to just see what is the right leverage for this industry or sector. So based on that, decision is to be taken. It is not that, because equity capital is always costly capital than debt. Debt rate is fixed, but the expectation of the equity shareholder is much higher return because their risk is higher.
Okay, but how you are saying that I'm getting a loan at 12% and equity is free? So how can you say this?
It is not free. The expectation of the investor is very important, and if you are not fulfilling those expectations, then there will be selling, there will be loss to the investors, and they will not subscribe to your shares.
There's a one-time cost is there, which is the equivalent to the 1 year cost of the debt, but market expectation is different, and you have to fulfill that expectation. If you're not fulfilling the expectation, then your share price will go down, and that will be a costly affair for you. Is it right?
Yes, sir.
Okay. So we have received around 70 questions, 46 here and 15 earlier, and we have tried to reply all the questions. For a knowledgeable company, if content, IP, trademark, exercise valued can be capitalized.
Yes, it can be capitalized, subject to the tax treatment and other. If it is a purchase good intangibles, it can be taken on the books of the company, and it is a depreciable asset in the books.
Okay. Okay. So I think we have covered all the questions, all the things, and we have given a reply to all. But in case anybody has any problem or any question is not clear, or they want to ask some other question, please write to us, we will reply. And if you want to bring out your IPO, then Manoj and Ruchika's team is ready to help people to prepare and plan and how to do this. So they have a corporate value enhancer product where they help the companies which are planning to go for IPO, and they will handhold from beginning to the end. And then post issue, Ankit can help them. So this is the process which we follow. So thank you very much, Ankit, Manoj, Ruchika, for giving answer of all queries. As ritual, 1 minute comments on this. So what you say, Ankit, what is your view on the overall aspects and things, which advice you want to give?
You are muted. You are muted.
Okay. So I think one thing I mentioned is that listing is a different ball game. There has to be a change. Management should be willing to adapt the change, and to adapt that change. Just the adaptation is not important. There has to be change in approach. You have to build those systems and processes in place so that you can survive. Because otherwise, you can obtain funds from public, utilize it, but to sustain in a long run, you have to act as a good governed listed entity, and that can only be possible if you intend to do so. And role of both promoters, management plays an important role.
Ruchika?
Sir, I think those 3 R's are very much important for coming out with an IPO. We are talking about how to plan for IPO, right valuation, right timing, and robust financial numbers are the basic summary which I want to give in the end. Because if I've seen cases when IPOs have been filed, but has been withdrawn because they were not getting the right value at that particular point of time. So it is very important for any management's call before coming out with IPO.
Manoj?
Well, if we see, as you have rightly said, that India is the brightest spot in the world, and hence everyone is looking. Indian market, capital market is also growing very fast. Investors are becoming more and more vigilant, more and more attractive towards the capital market and equity instruments. So funds are coming in the form of NPS. PPF is also allowed to put certain money. Pension fund over is also coming. So India fund should not be a problem. Obviously, right timing, right approach, and what is the right price at which issues should come should be considered. We should not look at that during last 1 year there is no major gain in the stock market. That should not be a criteria. Fund is available for right persons. So issues would be good, fully subscribe, and we can raise fund.
Okay. So thank you very much. My last advice to everybody: the IPO market is always there, but only thing is what you have to do is, because this is a long process, you have to make your company in right size, right structure, and the better valuation. Sometimes what is happening, like last question, somebody is asking that different things are intangible. You have a tangible asset, you have an intangible asset. So we are not able to understand what is intangible asset. So if you can prepare entire thing and the market gives valuation not only on a financial parameter, they give valuation on the basis of future progress as well as your intangible things which you have created. So you have a good networking person. You have a better valuation than the person who is most qualified. So the qualified person will get his valuation, but network person will get different valuation. But people don't give importance. So my advice is there is no time for public issue. You prepare your company, keep it ready. When the market is good, no bad, no wrong information, you just strike. Because when the market is on top, then you plan for public issue, and when you are prepared, then there's a possibility market will go down and market is not in a good condition. So you will miss the bus. So always the best advice is there is no IPO time. You prepare whenever you are ready. Your mindset is ready that I will bring out IPO and my promoter and everybody is ready for this. Or the promoter is also realizing that I am ready and I will create the infrastructure. I will have a robust team. I have a robust business, because business is robust. Then you can bring out then you can think. But bring out IPO when you have a robust team. Then you can bring out IPO. So you plan and then prepare it. Keep it ready. Go to the railway station with your baggage. When the right train is coming, you just enter into this. So this is the best thing you follow. So thank you very much, friends, and uh, for participating. And I received comments also that people really, because our basic purpose is that whatever we are doing, people should get something new from our discussion. So Ankit, Manoj, and Ruchika has given answer to them. We will organize another webinar on detailed IPO, because this is one program on relating to this. When we are going for other planning, we have to go into detail. So that we will do a separate webinar for this particular thing. So thank you. And as we are doing this particular thing continuously, next webinar on 24th, we are doing program on MCA 21 version 3. And we have invited Mr. Manoj Pandey as a chief guest and the team MCA for giving reply. As soon as we'll get a confirmation, we'll update to you. But this is our plan. So thank you very much.